What's up, everybody? It's Learn Something New here, and let's talk about building wealth. One of the smartest ways to grow your money over time is by investing in the stock market. But getting started can feel incredibly intimidating. Trust me, I've been there. That's why in this video, I'm breaking down everything you need to know about investing in the stock market, from the absolute basics to more advanced strategies. Whether you're just starting out, or you've been wanting to learn more about how to invest, this video is for you. So smash that like button, subscribe to the channel, and hit that notification bell so you don't miss out on any future videos. Before we jump into the specifics, let's break down some stock market basics. At its core, the stock market is essentially a giant marketplace where buyers and sellers come together to trade pieces of publicly traded companies, also known as stocks. Think of it like a massive online auction where prices constantly fluctuate based on supply and demand. When you buy a stock, you're essentially buying a tiny ownership stake in that company. If the company performs well, its stock price tends to go up, and you could potentially sell your shares for a profit. Conversely, if the company doesn't do so hot, the stock price might go down, resulting in a potential loss. Now, there are two main ways to make money in the stock market. The first is through capital appreciation, which basically means selling your stock for a higher price than you initially paid for it. The second way is through dividends, where some companies distribute a portion of their profits to shareholders on a regular basis. The stock market can be volatile, meaning prices can go up and down in the short term. That's why it's essential to do your research, invest for the long haul, and not panic sell every time the market dips. Now let's dive into some of the different ways you can invest in the stock market. We'll start with the most well-known individual stocks. When you buy individual stocks, you're essentially betting on the future success of that specific company. It's kind of like placing all your eggs in one basket, which can be risky if you're not careful. If picking individual stocks feels a bit too risky, that's where ETFs and mutual funds come in. These are basically baskets of stocks that track a particular index, sector, or investment strategy. For example, an S&P 500 index fund holds stocks of 500 of the largest publicly traded U.S. companies, giving you instant diversification. The main difference between ETFs and mutual funds is how they're managed and how often they can be traded. ETFs are generally passively managed, meaning they simply track an index and they can be traded throughout the day, just like individual stocks. Mutual funds, on the other hand, are actively managed by portfolio managers who buy and sell stocks within the fund. Finally, let's talk about bonds. Bonds are like IOUs issued by governments or corporations. When you invest in a bond, you're essentially lending money to the issuer in exchange for regular interest payments and the return of your principal at the end of the bond's term. Look, you wouldn't start a road trip without knowing your destination, right? The same goes for investing. You need to define your financial goals before you even think about buying your first stock. Are you saving for retirement, a down payment on a house, your dream car? Whatever it is, having a clear goal in mind will help you determine how much you need to invest, what your time horizon is, and how much risk you're willing to take on. Once you know your goals, you need to figure out your risk tolerance. Risk tolerance is essentially your ability to stomach market fluctuations without making emotional decisions. If you're someone who panics when your portfolio dips even a little bit, you might have a lower risk tolerance. It's all about finding what you're comfortable with and what aligns with your overall investment strategy. Now this is where things get really interesting. Before you invest in any stock, ETF, or mutual fund, it's absolutely crucial to do your research. Remember, you're essentially buying a piece of a business, so you need to understand what that business does, who their competitors are, and what their financial health looks like. Start by looking at the company's website, reading their annual reports, and checking out independent financial news sources. Pay attention to things like revenue growth, profit margins, and debt levels. These are all key indicators of a company's financial health. Don't just rely on what you read online, though. Talk to financial advisors, read books, and consider taking online courses to expand your knowledge. Remember, investing isn't gambling. It's about making calculated decisions based on research and analysis. One of the most important things to remember when it comes to investing is diversification. Diversification essentially means not putting all your eggs in one basket. Instead, You want to spread your money across different asset classes, sectors, and geographies to reduce your overall risk. Think of it like this. If you invest all your money in a single stock and that company goes bankrupt, you could lose everything. However, if you spread your investments across multiple stocks, bonds, and other asset classes, the poor performance of one investment is less likely to tank your entire portfolio. A well-diversified portfolio might include a mix of large-cap stocks, small-cap stocks, international stocks, bonds, and real estate. The specific allocation will vary depending on your risk tolerance, investment goals, and time horizon. Now that we've covered the basics, let's dive into some popular investment strategies. One popular approach is value investing, which involves finding undervalued companies that the market has overlooked. Value investors look for companies with strong fundamentals, solid track records, and the potential for future growth. Another strategy is growth investing, which focuses on investing in companies that are expected to grow at an above-average rate. Growth investors are less concerned with current valuations and more interested in a company's potential for future earnings and expansion. Then there's dollar-cost averaging, which is a simple yet effective strategy that involves investing a fixed amount of money at regular intervals, regardless of market conditions. This helps to mitigate the risk of investing a lump sum at the wrong time and can potentially lower your average cost per share over the long run. The best strategy for you will depend on your individual circumstances, risk tolerance, and investment goals. Chapter 7. The long game versus the quick flip long-term versus short-term investing. When it comes to investing, time horizon is a crucial factor to consider. Long-term investing typically involves holding investments for several years, if not decades, with the goal of benefiting from long-term market growth. It requires patience, discipline, and the ability to ride out market fluctuations without panicking. Short-term investing, on the other hand, involves buying and selling investments over shorter periods, often in an attempt to profit from short-term market movements. It can be incredibly risky and requires a deep understanding of technical analysis, market timing, and risk management. Historically, the stock market has trended upwards over the long term, but there will always be short-term fluctuations. By adopting a long-term investment horizon, you're essentially giving your investments more time to grow and weather market storms. Remember, investing shouldn't be about trying to get rich quick. It's a marathon, not a sprint. Focus on building a solid, diversified portfolio that aligns with your long-term goals and let time do its thing. Chapter 8. Investing made easy. Apps and platforms. Gone are the days of calling up a stockbroker and paying exorbitant fees to make trades. These days, there are tons of apps and online platforms that make investing easier and more accessible than ever before. Some popular options include Robinhood, M1 Finance, and Fidelity, all of which offer commission-free trading and user-friendly interfaces. These platforms provide access to a wide range of investments, including stocks, ETFs, mutual funds, and even cryptocurrency. Many of these platforms also offer educational resources, research tools, and even robo-advisors that can help you build and manage your portfolio. Remember to do your research and compare different platforms to find one that meets your needs and budget. Chapter 9. Staying ahead of the curve. Market news and trends. The stock market is constantly evolving, so it's crucial to stay informed about market news and trends. There are tons of great resources out there, including websites like Bloomberg, Wall Street Journal, and CNBC, as well as financial podcasts and newsletters. By staying informed, you'll be better equipped to make informed investment decisions and adjust your portfolio as needed. Chapter 10. Rookie mistakes. What not to do. Even seasoned investors make mistakes, but there are a few common pitfalls that new investors should be particularly aware of. One of the biggest mistakes is investing based on emotions, whether it's fear, greed, or FOMO, the fear of missing out. When the market is doing well, it's easy to get caught up in the hype and make impulsive investment decisions. Conversely, when the market is down, it's natural to feel scared and want to sell everything. However, it's important to remember that the stock market is cyclical, meaning it goes through periods of ups and downs. Another common mistake is not diversifying your portfolio. As we discussed earlier, diversification is key to managing risk. Don't put all your eggs in one basket, no matter how promising a particular investment may seem. Focus on building a solid, diversified portfolio that aligns with your long-term goals and be patient. Outrow, start investing in yourself. So there you have it, a crash course on investing in the stock market. Remember, investing can be a powerful tool for building wealth over time, but it's essential to approach it with the right mindset, knowledge, and a healthy dose of caution. Don't be afraid to start small, learn as you go, and seek professional advice when needed. If you found this video helpful, be sure to give it a thumbs up and subscribe to the channel for more videos on personal finance, investing, and building wealth.